Welcome to this explainer. Okay, today we're literally peering inside the vault to deconstruct the hidden mechanics and the rapidly evolving regulations of the commercial banking industry. We interact with banks every single day, right? But behind those ATMs and the slick mobile apps is a highly complex, heavily regulated machine.
So it kind of makes you wonder, what actually powers these massive essential financial engines? At their core, commercial banks take in deposits and they pump out loans to individuals, corporations, and even massive infrastructure projects. They serve an absolutely essential role in the functioning of global economies, basically facilitating the transfer of financial resources to wherever they can be the most productive. But how do they actually balance making a profit with the immense risks involved?
Well, here's our roadmap for today. We're going to cover 1. The core drivers of commercial banks, 2. Risks and the 2008 shift, 3. Guarding data and ethics, 4. ESG and financed emissions, and 5. Expanding financial inclusion. Let's dive right in.
Part 1. Core drivers of commercial banks.
Okay, so the health and profitability of a commercial bank really boil down to a few fundamental operational drivers. First up is deposit volumes. Banks need your deposits. That is literally the capital they use to operate. Second is loan quality. It doesn't matter how much money a bank lends out if the borrowers just default, right? They have to rigorously assess the creditworthiness of every single borrower. Third, the broader economic environment. This dictates everything from consumer spending to business expansion. And finally, interest rates. Banks essentially make their money on the spread. That's the difference between the interest they pay you for your deposits and the interest they charge borrowers for loans. So when interest rates fluctuate, the entire commercial banking industry feels the tremors.
Moving on to Part 2, Risks and the 2008 Shift.
Now, this right here is the fundamental fragility of traditional banking operations. It's kind of like a high-wire balancing act. Think about it. A bank takes in short-term liabilities, like your checking account, which you can withdraw from at any second. But they take that money and use it to fund long-term assets, like a 30-year mortgage for a home buyer. If suddenly everyone wants their short-term deposits back at the exact same time, the bank doesn't have the cash on hand because it's locked up in those 30-year loans. This mismatch is the absolute core vulnerability of the entire commercial banking model. And wow, 2008 showed us exactly what happens when that balancing act fails on a global scale. That crisis completely blew up how regulators define risk. It's no longer just about bad loans. Since then, the regulatory landscape has become incredibly stringent, expanding to encompass operational and even climate threats. Regulatory bodies like the SASB have really taken charge here. They're pushing commercial banks toward rigorous new reporting standards that are going to take full effect by January 2027. So banks aren't just reporting their profits anymore. They're heavily audited on their sustainability and overall risk management.
And to prevent another 2008, banks now have to rigorously track their GSIB scores. That stands for Global Systemically Important Bank, across 5 incredibly complex categories. A bank just isn't judged solely by its size anymore. Regulators look at interconnectedness. If this bank fails, who else goes down with it? They look at substitutability. If this bank disappears tomorrow, can customers easily go somewhere else? Or is the global infrastructure too reliant on them? They measure the complexity of their trading and their cross-jurisdictional footprint. Banks literally have to undergo supervised stress tests based on these exact metrics, just to prove they have enough capital to survive a disaster.
Which brings us to Part 3, Guarding Data and Ethics.
The massive shift to cloud storage and mobile banking means these institutions are constantly defending against evolving attack vectors. We're talking about highly sophisticated threats here: ransomware, remote access attacks, loan stacking schemes. As banking becomes entirely technology dependent, failing to safeguard this data doesn't just result in massive fines, it completely shatters consumer confidence. Honestly, it's a modern bank robber's dream. No getaway car required, just a Wi-Fi connection. And the reporting standards totally reflect this new reality. Regulators are forcing banks to disclose not just the total number of data breaches, but specifically the percentage of those that are personal data breaches, and exactly how many account holders were affected. It's all about transparency. Investors and customers want to know exactly what kind of information was compromised and exactly how the bank responded to secure their systems. But hey, ethics goes way beyond just digital threats. Banks have to actively protect their brand and their shareholder value by enforcing strict business ethics. Under the SASB standards, banks actually have to explicitly report the total amount of monetary losses they suffer as a result of legal proceedings tied to fraud, insider trading, market manipulation, or anti-competitive behavior.
They also have to clearly outline their whistleblower policies, ensuring there are independent hotlines and real incentives for employees to report violations before they spiral into systemic disasters.
All right, part 4, ESG and financed emissions. So the SASB standards, which are now housed under the IFRS Foundation, they literally force banks to bake environmental, social, and governance, or ESG factors, directly into their credit analysis. They aren't just looking at a company's cash flow anymore. They're looking at carbon-related assets, water-stressed regions, and how climate policies might make a borrower's entire business model obsolete. Because if a bank lends to a company that goes bankrupt due to environmental regulations, well, that credit risk falls right back onto the bank. Now, here is where it gets really fascinating. A bank's traditional emissions, Scope 1 and 2, that's basically just the energy used to keep the lights on in their corporate offices. That's a relatively tiny footprint, right? The real climate risk for banks is Scope 3, their financed emissions. This means measuring the greenhouse gas emissions generated by the industries, the real estate, and the companies that the bank actually lends money to. If a commercial bank funds a massive fossil fuel project, those emissions are tracked straight back to the bank's own risk profile. They have to disclose their gross exposure for every single industry to show the world exactly where their money is flowing.
And finally, part 5, expanding financial inclusion.
So, why does all this massive global regulation matter to everyday people? Well, because commercial banks are also graded on their societal value. Modern reporting tracks very specific inclusion metrics, like the sheer number of fee-free, no-cost checking accounts provided to previously unbanked or underbanked customers. We're talking about individuals who historically had to rely on predatory alternative financial services. Think payday loans or pawn shops. Bringing them into the secure, regulated banking system is a core metric of a bank's social responsibility.
Modern banks basically have to balance their huge corporate portfolios by actively expanding capacity at the community level. They disclose the exact number and monetary amount of loans outstanding that qualify for small business and community development programs. But it's definitely a delicate balance. They need to provide capital, but without engaging in irresponsible lending. And crucially, they have to pair this access with actual financial literacy initiatives, like workshops and counseling for underserved customers to help them navigate credit responsibly.
From managing the inherent risks of mismatched assets and guarding against cyber threats, to calculating the carbon footprint of the companies they fund and bringing the unbanked into the financial fold, the commercial banking industry is just so much more complex than a vault holding cash. So I'm going to leave you with this. In a rapidly evolving world, is your bank balancing the risks of tomorrow or just the books of today? Thanks for joining me for this explainer. I really hope this gave you a powerful new perspective on the engines running our global economy.